Talk now about one of my favorite topics, really, in all of finance, is the discussion of, can you beat the market? Is it possible to beat the market? When I say beat the market, what I mean by that is it possible to outperform the stock market as a whole consistently? So on average, the stock market in the U.S. returns about 10% year over year. And that includes both the average increase in the price of stocks and also the dividend payments that occur. Okay? If we think about that in real terms, so adjusting for inflation, historically the real return has been about 7%. All right? So what that means is if you put $1,000 in the stock market, on average, you can expect to have $1,100 the next year. Or if you put $1,000 in the stock market today, you can, a year from now, have what would feel like $1,070 today, adjusted for inflation. Okay? Of course, there's a significant amount of variation. There's a significant amount of risk and volatility involved with this, but that is the average historical return. So the question is it possible to do better than that? Is it possible to earn more than 10% in a given year? All right? And to think about this, we really need to discuss some pretty interesting and complex issues, but we can start pretty simple here and just think about, is it feasible or not? And, what would that practice imply? Problems with beating the market. First of all, let's recognize that beating the market means, by definition, you must not be fully invested in the market. In other words, you must not be completely diversified. So if the stock market on average earns 10%, the only way to be completely diversified would be if you invested in the entire U.S. stock market. And indeed, there are assets that do that. We've mentioned them before. We've mentioned index funds, all right? So there are various forms of index funds that track the entire market. One really famous one, if you search this, if you're looking for a place maybe to invest some money and you want to just be diversified and not really worry about it too much, you might look up this, VTSAX. This is a total stock market fund that's put out by a really important investment company called Vanguard. And all it does is it invests in all the companies, invests in all of the publicly traded companies in the United States on a price-weighted basis. So bigger companies like Microsoft, you're going to get a relatively big chunk of that, and then teeny tiny companies, you'll just have a teeny tiny bit of their stock in your asset. Okay, so what this means is if you wanted to diversify as much as possible but still have all of your money in the stock market, you would need to invest in something like VTSAX. On the other hand, if you're hoping to earn more than 10%, the only way to do that would mean that you're less diversified. You can't be any more diversified than this. And this is on average going to earn 10%. So in order to be in order to be less diversified and still have all of your money in stocks, you can't hold the entire market. Okay? So therefore, you have to be taking on more risk. And there's two different types of risk that we can think about when it comes to stock market investing. There's systematic risk. Systematic risk is unavoidable risk for a stock investor. So if you're going to invest in stocks, there's an inherent amount of risk, right? There's always going to be a risk if you invest in stocks. So if I take $100 out of my wallet right now and I go invest it in stocks and I put it in the VTSAX in a total stock market fund, something like that, I have only taken on systematic risk. In other words, I have the smallest amount of risk I could take while still having all of my money in the stock market. All $100 went in, all right? I could put just my money in one stock. That's very risky. I could put it in 100 different stocks. That's less risky. The least amount of risk I could take while still having all of my money invested is to just have systematic risk by just investing in the entire stock market. If I take on any more risk than that, then it is idiosyncratic risk. This is avoidable risk. that doesn't align with greater returns. And if we look at research out there on investing, it kind of teaches us this, all right? If you invest in the entire stock market, on average, you can expect a return of about 10% and a relatively low standard deviation in regards to those investments, all right? If you instead invest in individual stocks, what that tells you necessarily is that the standard deviation, which I'm just signifying with a little sigma there, the standard deviation necessarily must be higher. So if I decide I'm going to gamble and put my money into GameStop, naturally my investing is going to have a lot greater volatility, a lot more risk. And unfortunately, what the research shows is the expected return is actually 10% or even lower. So people who invest their money in an undiversified asset pool by picking stocks, on average, underperform relative to the most diversified thing you can do, which is investing in the entire total stock market. So this suggests that you shouldn't be picking stocks, but there are a lot of people that still do. All right, so we need to really think about our view. Okay, we need to think about your personal view. I'm going to kind of give you mine, but we need to definitely, if we're going to invest, we need to have some idea of why we're choosing what we're investing in. Can we beat the stock market? Should we pay someone else to beat the stock market for us? Is it even possible? And that's what we're going to try to talk about in this little video. So the first thing to recognize is that anytime you're not investing in the entire stock market, anytime you're picking and choosing stocks, you will take on more risk. So picking stocks, which is called active investing. Okay? Active investing means that you are literally picking and choosing what stocks you're going to buy. Or it might mean that you're hiring someone else to pick stocks for you. That's active. Passive investing is when you're just broadly investing in something like that total stock market fund, that VTSAX that I mentioned before. And so what we know right away is that when you're picking stocks or active investing, you have to be taking on more risk. All right? If I have all my money in the stock market and you have all of your money in the stock market, all right, you cannot have any less risk than putting it in the total stock market, which is passive. If you're picking and choosing stock, you'll have to take on more risk. All right? So when it comes to beating the market, that is one potential problem. Let's think about the other ones. I'm just going to label this one arrogance. Maybe you agree, maybe you don't. I think I've spelled arrogance there correctly. Let's think about what a trade is. Anytime you buy a share. So if I go online right now and I buy some Coca-Cola stock, anytime I buy stock, someone else is selling it. So anytime you buy, someone else is selling. So think about what that means. If you think Coca-Cola is a good deal or it's underpriced right now, what you're saying is you know more than the other person does. Right? For every transaction, someone is selling and there's a buyer there. Now let's think about who might be the seller. If I buy Coca-Cola stock, there's a really good chance that the person selling me that share is a professional investor. Someone who manages a lot of money. A lot of the trades that happen in the private market are done by these big corporations. So my question is to you, if you're buying GameStop or Tesla or whatever because you think it's going to go up in value, what makes you think you know more than the person that is selling that share? It's possible that you do, but you can imagine why it's going to be tricky. And I have students all the time. I get emails frequently from students who ask me things like, can you tell me about day trading? Can you tell me, is Tesla going to go up? And my answer is always the same. I don't know what's going to happen to the value of any of these companies. There may be some people that are smarter than me that can figure that out, but trying to pick and choose stocks is incredibly difficult because think about what determines the price of a stock, all right? So let's just choose some random company, or not so random in this case. GameStop, since they've been in the news lately. Share of GameStop is something like $220, right? Think about what that means. Think about how that price it comes to be. Ultimately, that price is a perfect equilibrium of supply and demand. the stock market indeed reaches perfect equilibrium. It has to, okay? So at this moment, supply and demand are perfectly matched at that price of $220. Now, what if people expect GameStop to go up? If people simultaneously all expect GameStop to go up, let's say that some big news comes out, right? That GameStop has developed some new platform that people are really going to like. Its price will go up, all right? But what you need to imagine here, if you want to think about kind of like a seesaw or some sort of scale, all right? You can kind of imagine a scale. And what the stock market does is it perfectly balances the people who expect the price to go up. So there's always going to be some people who expect GameStop to go up. And there's also going to be some people who expect the price to go down. And what this price of $220 does is it perfectly balances the people who expect it to go up versus those that go down. It balances those that are bullish and those that are bearish. So if you're a person who thinks that GameStop should be bought, that GameStop's going to go up in value, what you're saying is you know more than the collective wisdom of millions of investors. Millions of investors have pushed this price to $220. So if you think it's going to go up, what you're saying is you know more than the collective wisdom of millions of people. To me, that's always felt way too arrogant for me to buy into the idea that I can pick and choose stocks and outperform the market. But again, that is just me. There may indeed be people that are capable of this, but it's hard to find. And indeed, if we look at the evidence of people who are actively trading, picking and choosing stocks, they have a very poor track record. So let's talk evidence here a little bit. Pretty easy actually to figure out if people can beat the market professionally. Now, I can't go into individual traders' accounts and see how they're doing. I know there's people in this class that have made a lot of money trading in the stock market. There's not much data on people like you, okay? But what we do have data on is professional traders who are managing funds, okay? So for example, there's all of these mutual funds that exist. We can look at like University of Harvard, they have their endowment, and there's someone investing their endowment. So we have these public measures of people's performance. And here is what we find. Active traders underperform the market. And they don't underperform the market by just a little bit. They underperform it significantly. So what that means is, if you just invest your money in a total stock market fund, you will on average beat a professional investor, which is very interesting. You know, you might wonder, why would that be the case? Why would anyone pay the professional investors? Well, indeed, it's starting to shift. More and more investors are going to passive investing, which might have some interesting consequences in our debate later on here. So not only do active traders normally perform worse, but even the ones who are successful actually regress. So those that outperform in 2021, for example, so if you imagine some money managers that have a really good year, those that outperform in 2021 are not statistically any more likely to outperform in 2022. In other words, if you're good one year as an investor, as an active trader, it appears that doesn't really tell you anything about what happens in 2022. So what that means is the people who do well in a given year, they're just lucky, all right? Now, maybe some of you are thinking, what about the people who do really well? What about people like Warren Buffett? Well, you know, you can make the argument that Warren Buffett was lucky. You can make the argument that Warren Buffett, maybe, you know, back in the 80s and 90s, maybe it was possible to be outperforming the market then, but it's gotten much tougher now. There's certainly some merit to that. But I would just point out that Warren Buffett has actually performed poorly over the last decade. His company, Berkshire Hathaway, has not done very well. And Warren Buffett actually himself has said that he thinks that people should be trading passively. He believes that investing in total stock market funds is the way to go. He actually had a contest against someone. Someone else argued that they could beat his passive fund, and he said, well, I'm just going to invest in the total stock market, and he won the argument. So even professional traders like Warren Buffett understand that beating the market is extremely challenging. All right? So let's talk about why active investors might struggle. At the very least, you would think if I'm investing in the total stock market, then someone who's just picking and choosing stocks, maybe on average they should perform as well as I do, right? I mean, if I've got all the stocks and they've got only 1% of the stocks, you would think maybe they would just have more risk, but they would still get that average 10% return. But it turns out that active investors, people picking and choosing stocks, perform worse than the market as a whole. And there's a few reasons why this is the case. One is that active traders, keep it in mind, active trading just means you're picking and choosing the stocks that you want to invest in. Active traders must sometimes have money out of the market. This could be for a long period of time, or it could be for a short period of time, okay? So, for example, just a very minute example of this would be, let's say that right now I'm invested in Amazon, all right? But I really think that Hasbro is about to go up in value. Well, I'm going to have to sell my Amazon stock to give myself some cash, and then I'm going to go buy Hasbro. So maybe there's just a minute or two there where I'm out of the market. No big deal. But a more problematic thing would be an investor who takes their money out for a long period of time. I've heard people do this a lot. This is a really common thing. People get worried the market's going to go down, so they just hold a bunch of money in cash waiting for a market drop. I hate to say it, but that's kind of dumb, all right? That is not a good strategy. On average, the market goes up. So taking your money out of the market is a really bad move, all right? Think about it this way. If I ask you the question now, over the last 50 years, I'm going to give you $1,000 50 years ago. What would you like to do with that money? Over that 50-year period, I bet you would want to have your money invested the entire time, all right? Now, we know that there's some catastrophic events over the last 50 years. We had a stock market crash in 87. We had another one in like 2001, another one in 2007, 2008. So we've got these financial crises, but we never could have predicted those at the time. So over the last 50 years, if you just put your money in the market and just left it, it would be worth so much more today. So the best strategy, on average, is to have your money in the market. On average, the market returns 10% in a year. If you have it out of the market, you earn 0%. So the best policy is just to have it in all of the time. So one problem with active management is anytime you're buying something, there must be a period where you have cash, right? Anytime you make a purchase, you're doing it with cash, which means you have cash sitting on the sidelines sometimes. And this leads to the often heard phrase that time in the market beats timing the market. Keeping your money in the market is better than trying to pick and choose to put your money in when you think the market is most apt to go up. And this is a very trite phrase. If you look into investing, you're going to hear this term a lot, but it's good advice, all right? Just keep your money in the market. Active traders can't do that. A second problem with active trading is that active trading is taxed more heavily. And this is generally, but not always, the case, all right? Active trading means that you have to buy and sell stocks frequently. And the problem here is that when you hold stocks for a short period, you'll be taxed as income. By the same token, when you hold stocks for a short period of time, the dividends are also taxed less favorably. So this is going to be a problem because this means that for an average investor that maybe can get 11%, let's imagine you're a really good investor and you figured out a way to earn 11%, beating the market. The problem is, even if you're earning 11%, you might actually underperform your peers simply because you're getting taxed at a higher rate. So this definitely makes it more difficult to be profitable in the long run with active investing. A third problem, and this one is specific to money managers. People who have a lot of money that they're investing, right? People running mutual funds. There's a problem of scale. As an example, let's say that I just have $10,000 to invest. For somebody who has $10,000 to invest, think about where you would put that money. Let's imagine you're an active investor, right? If you have $10,000, you would take that money and you would put it on the best possible deal you can find, all right? So this would go to your best investment. Maybe there's just one particular asset that you know is going to go up in value. Well, you could take that $10,000 and put it into that asset, and you could probably do pretty well, perhaps, all right? The problem here is, if we think about this from a money manager standpoint, imagine this is a professional investor that's just getting started, and this professional investor indeed finds a great investment and earns profits. What's going to happen is more money is going to flow their way. Other people are going to want you, this person here, to invest their money for them too. So what happens is, over time, these successful money managers will end up with more money. So maybe now, instead of investing $10,000, they end up with a $10 billion portfolio. This is going to create a problem, because you can't just put $10 billion into your single best investment. Mentioned Hasbro before, right? Hasbro is a little toy company. They produce like Frisbees and stuff like that. If you put $10 billion into Hasbro, that's enough money to actually drive its price significantly up. So $10,000, you can buy the stock, you don't really change the price. But if you put $10 billion into Hasbro, its price will shoot up so much that it'll no longer be a good investment for you. So what this means is, you can't just choose the best investment. You're going to have to spread this out over many different investments. Okay? So you're going to have to figure out many different investments. That's a problem for a couple of reasons. One is, you no longer can just, choose your best investments. If you've got one really good deal is not going to be adequate. You need a lot of good deals. So for one problem is, you can't just hammer home and put all your money in on one good bet. The other problem is that you might not have the time or the ability to do enough research to find a lot of different investments. So the more money that a manager has to try to invest, the harder it is for them to find these free lunches, these underpriced assets that can yield profits. So scaling is a big issue, all right? And what I'm referring to there when I say scale is that process of scaling up, right? Economies of scale, getting bigger. As a fourth and final problem, and like number 3, this one related really to not individual investors. Not like, if you have a little stock market account, I'm not talking about you here. I'm talking about money managers, people who own mutual funds and run them. Same deal with number 4 here. All right. So a lot of people like to invest their money into like financial advisors or with mutual funds, and there's someone managing that money. One problem with that is the problem of scale. Okay. And another problem is the short-term focus. The problem here is, if you're a money manager, think about the implications. If you're a really good money manager, what you should know is that passive investing is at least a viable option, right? So passive investing is just investing in the entire stock market. So one possibility that you could do as a money manager is just put all of your money into the total stock market fund. The problem is then, though, you're not really doing anything. So people aren't going to want to pay you to manage their money if you're just going to invest in something like the VTSAX that I mentioned before, all right? So instead, you're going to have to pick and choose certain things to invest in. That's going to be riskier. And the problem is, it might also be a poor play. Inherently, there's going to be a short-term problem here. You're going to have to focus on the short term when you think about clients. For example, let's say in 2021, the stock market goes up 18%. Okay? So a good year. And let's say that your mutual fund also goes up 18%. For me, if I'm looking at this, I'm saying this was a good win for the money market mutual account, or the mutual fund runner, right? The person running this account has managed to do just as well as the stock market. But the problem is, the mutual fund runner charges a fee. So if I'm somebody who's allowing this person to run my money and they're costing me, thousands of dollars a year, I'm going to say this is a bad deal for me. I'm going to take all my money out of this mutual fund and I'm going to go invest it somewhere else. okay? Because after all, I could have just put all my money in the stock market and done just as well. So instead, what this person is going to be forced to do is take on extra risk. They're going to have to take on extra risk so that I will keep my money with them. So what they're going to do is they're going to take on risk. And maybe they take on risk in the sense that they figure out a way to have a 50% chance of earning a 30% return and a 50% chance of earning a 0% return. No change there. This is a better strategy if you're the mutual fund runner, because think about it. If you just earn 18%, people aren't going to invest with you. You're just tying the market. You're not doing anything special. But if you take on some risk and you earn 30% return, money is going to pour into your account. If you earn a 0% return, you might lose some of your customers, but there's always going to be some that really don't pay attention, right? Those that don't pay attention, they're probably going to stick around anyway as long as you don't have a catastrophe, right? So those that are able to take on more risk in the long run are going to get more clients, all right? And through more clients, they can earn greater profits. You have to take on risk. You have to, okay? Because if you're just matching the market, no one is going to think that you're a good market manager. You're not running your mutual fund well, all right? So inherently, there's going to be a short-term focus. Let's imagine that there's a stock that you expect to do really well at some point in the future, right? Let's say that you have identified, Intel. Let's say that Intel is a company you're just certain that over the next 20 years, Intel is going to go way up in value. The problem is if you invest all of your money in Intel and over the 6 months they perform poorly, again, people are going to take their money out of your account, right? So you have to figure out a way to find these short-term stocks that have the potential of going up, which means more risk, it means less diversification, and it means you're not thinking about the long run, when indeed stock market is inherently a long-run game. So these are some potential issues with active investors, all right? All 4 of these relate to mutual funds, relate to these professional stock pickers. The first 2 relate to individual investors, maybe somebody in this class that invests in the stock market. Now, is it possible to beat the stock market in the long run? It's very tricky, but to fully think about that, we need to identify some of these problems, and we also need to consider this idea of the theory of efficient markets. So let's stop dancing around the issue and let's dive right in and talk about the efficient market hypothesis. An amazingly interesting topic in my eyes, and one that I spend a lot of time thinking about. This is sometimes referred to as the theory of efficient markets. Often you'll see it abbreviated EMH when we're using the nomenclature there, the efficient market hypothesis. And this was an idea that was developed over a long stretch of time, but made famous by Eugene Fama, who went on to win a Nobel Prize in economics based on these ideas. He developed these theories, I want to say in 1970 is when his main theories came out. But interestingly, we didn't really use these academic ideas in the private sector until many years later. So it took a long time from these concepts to go from a concept that people believed in to something that actually people would invest in. And the logic of the efficient market hypothesis, I think we've already got a taste for. This is the idea that the current price of stock, of any stock, is based on all knowable information. And this is why we can make the argument that active investing doesn't work. Because if we think about the share price of any asset, so if we think about the share price for Google, or Alphabet really I should say, and we would say it's $1,300 a share right now, what this would suggest is that $1,300 is based on expectations of future dividends, the economy, expectations about what Google's going to do in terms of things they might buy, things they might sell from their, from their overall hold of companies that they own. And basically, if it's based on all knowable information, there's no way to predict it. The share could go way up, the share value could go way down, but you wouldn't be able to predict these big swings. That's the theory of the efficient market hypothesis, okay? Just to give you a couple of examples of why this works. I had a friend a few years back who, this idea always stuck with me when he was discussing this. He didn't know much about investing, and he had this theory that he used it every single year, and that was that he would invest in Abercrombie and Fitch in May every year, and then he would sell in August. And he was like, Brent, you're going to love this idea I've got. This is what I do every year. I buy Abercrombie in May, and then in August I sell. And I've made profit. Chances are you are going to make profit if you do this, because if you own any stock and hold it for any length of time, chances are it's going to go up in value because the stock market as a whole goes up in value. He really didn't know what he was doing. And his logic here was that Abercrombie sells a lot of summer clothes, so they were going to make their profits in the summer. So he wanted to only own Abercrombie in the summer. This is idiotic, right? This is really dumb. The problem with this is he didn't understand the way markets work, the dynamics of the stock market. The issue here is, if we expect the value to go up in the summer, then when would you want to buy the stock? Right? If you expect the value to go up in the summer, when would you want to buy it? Well, then you would want to buy it in May. And that's as far as his brain got, all right? Buying it in May makes sense because then you'll own it during the summer. Of course, if you buy it in May, what that does is, if a lot of people have this thought, is the price will go up, okay? So if everyone's trying to do the same strategy, the price will go up in May. So what do you want to do then? Well, if you know the price is going to go up in May, then what you want to do is you want to buy it in April. And of course, anyone with half a brain could realize that too. So what that means is the price would go up in April. And you can just unfurl this all the way back to realize that the current price already incorporates the potential of a good summer. That's the basic idea behind the theory of efficient markets. That whatever the price is today already reflects future information about that stock. That's why Tesla's stock is worth a lot, because people expect it to be worth a lot in the future. They're already thinking about the future. We don't know that Tesla's going to do well, but the price reflects the fact that people will expect Tesla to outperform. Things can change. It can go way down in value. It can go way up in value. The theory of efficient markets is not saying markets are predictable. It's saying the opposite, that markets are unpredictable, but the price reflects everything that we can possibly know about that company. All right? And I'm going through this slowly and explaining it because from my experience, a lot of people have a real hard time understanding what the theory of efficient market means. I've had students think that it means you can predict the market, and I've had students think that it means you can't predict the market. And the reality is somewhere in between. What the theory of efficient market suggests is there's a portion of the market that is predictable, but that portion of the market that is predictable is known by everyone. And so the price already reflects that knowable information. All right. We can think about some evidence for this. And the biggest is something we've already talked about, and that is that active investors perform poorly relative to the market overall. And this is most dramatic when you think about long time periods. So some research I was just looking at, over a 1 year period, about 36% of active investors, so this is like professional active investors, about 36% of active investors beat the market on average. All right, so what that means is if you take an average investor who's active, picking and choosing stocks, only about a third of the time do they outperform just the total stock market in a given year. And if you look at longer time periods, such as 15 years, the number is much smaller, about 8.5%. So this just goes to show that even the people that are professionals, the people that are getting paid to do this, they actually seem to operate in a way that suggests that it's very difficult to pick stocks, perhaps impossible. And if it's impossible to pick stocks over the long term, then the theory of efficient market would generally bear out. It would be true. All right. So that's one bit of information that would report this or purport that benefit. But we also have counterexamples. So on the contrary, we do know that some investors do beat the market. and some investors have beaten the market for, a really nice chunk of years, several years in a row, 18 out of 20 years, things like that. But the problem is that for these investors that beat the market, it's not out of the realm of regular statistical randomness that there would be some that would beat the market. Everybody wants to talk about Warren Buffett. Warren Buffett has had an amazing career. I mentioned earlier in this video that he's done poorly, though, over the last decade. So you can look at somebody like Warren Buffett and say, he must have some special skills. But if there are millions of people that are investing, wouldn't it be likely that there would be a couple that would perform extremely well? Isn't that just the way randomness works? That if there are millions of investors, one or two are going to have absolutely amazing results. And you're going to hear about those one or two. There's also going to be one or two that have absolutely horrible results. You're probably not going to hear about them. And you're not going to hear about all those people who have average results. All right? So there's a bit of a survivorship bias and a bit of an information bias. People who outperform the markets, you're going to hear from them because it's interesting. And secondly, people who beat the market are likely to attain more money. They're likely to continue to be professional stock traders. Whereas the ones that are unsuccessful, they're just going to die out. They're going to go away. So what you're left with is a vocal group of investors that have done well, saying that they're able to beat the market. And they are totally incentivized to make that claim. So despite the fact that there are some that beat the market, that alone does not tell us that the market can be beaten consistently. However, there are some interesting trends to consider. So if we think about stocks and how they perform over time, there are some interesting results. For example, October tends to be a really bad month for stocks. A lot of stock market crashes that have happened in October. October has a very low performance overall. I think Octobers, if I'm not mistaken, over the last 50 years have been down on average. So Octobers tend to be a period where the stocks drop. Friday is a really good day for stocks. The average Friday, stocks go up by about 0.15%, which is a lot. On the contrary, Thursday, on average, stocks go down. So we could suggest that maybe this is indicative of there being some trends. And if there are trends, the efficient market hypothesis is wrong. In other words, if you could just always sell stock on Thursday and then buy on Friday, and that was always profitable, what that would mean is the market is not efficient because the market is not using all knowable information. However, again, think about all the different things we could look at, right? We could look at spring versus summer, fall and winter. We could look at end of the month, beginning of the month, middle of the month. We could look at months that have 5 Sundays, different days of the week, different months. There's so much you could look at that chances are you're going to find some statistical evidence that there is something happening, all right? Some of you have taken statistics, you think about hypothesis testing. If you get a p-value of 0.05, what that suggests is there's a 95% chance that your result would not happen if it was just purely random, all right? So it's likely that your event is really telling you something. But if you're testing thousands of hypotheses and going and searching and data mining through thousands of different possibilities, you're going to find some results like this. So yet again, despite the fact there are trends, that does not conclusively show us that the efficient market hypothesis is invalid, okay? So why can't we know? Why can't we figure out if the efficient market hypothesis is true or not? Well, this is, to me, what makes it so interesting and what makes it so debated. There are so many smart people I know that completely agree with me and so many that completely disagree with me, right? And I'm just one person. I tend to believe in the efficient market hypothesis quite well. I tend to believe that it's true most of the time, the vast majority of the time. And for most people, they should just pretend that it really does truly exist. Invest passively. Don't try to pick and choose stocks, okay? But let me tell you why we don't know for sure. There's something called the joint hypothesis problem. The joint hypothesis problem. And basically, here's what we can think of. If we wanted to test this hypothesis, maybe that the efficient market hypothesis is true or false. If we wanted to test that, we would first need to figure out what the correct prices should be. So we would not only need the hypothesis of, is the efficient market hypothesis true? We would secondly need some sort of hypothesis that some stock price, for example, $16.12 for some random company, is the efficient price. And the problem with this analysis is there's no way to determine where that price comes from. Stocks are forward-looking. Stocks look into the future. When people are trying to decide whether or not to buy a company, they think about the future. And so what that means is there's no way to figure out what that price should be. We can do something like the dividend discount model, but we don't really know G in that formula. We don't really know the risk premium. So since there's no way to determine what the efficient price is, there's no way to figure out if we're at that price. So the efficient market hypothesis can never be proven true, and it can never be proven untrue, which puts it in this very weird quandary. And it's a big issue. It's a big question to ask. All right, we have big organizations. I mentioned Harvard before. Harvard has an amazingly large amount of money in their funds, right? So they have this massive endowment of funds, and they're paying people to manage that fund, paying them a significant amount of money. If the efficient market hypothesis is true, then they are totally wasting their money. And indeed, the Harvard Endowment Fund has underperformed the market. So the ramifications here are worth billions of dollars to big businesses and big entities like Harvard. But we can never prove for sure that the efficient market hypothesis is true. And in this very class, as I mentioned before, I know there's students that have done really well, that have made a lot of money in the stock market. Are they lucky, or do they really know what they're doing? There's no way to know for sure. But what the efficient market hypothesis would suggest is if they have a successful year in 2021, that doesn't mean that they're going to have a successful year in 2022, unfortunately. But I'll still be rooting for you. As a final note on the efficient market hypothesis, I wanted to talk about what the efficient market hypothesis doesn't tell us. And I'm doing this because I've noticed in the past that students have had a little bit of trouble with this, and I totally sympathize with that. Because in fact, really smart people, economists, chairs of the Federal Reserve, apparently don't understand what the efficient market hypothesis is. So this is an example of what I mean by this, okay? John Quiggin, kind of a famous economist back in 2013, he said that Bitcoin is perhaps the first pure example of a bubble. And what he meant by that was that without question, Bitcoin was going to go down in value. And he knew that because Bitcoin didn't have any real value, okay? And he went on to say that, that basically this was the first time we can show that the efficient market hypothesis is wrong. This is really dumb thing to say, okay? First of all, bubbles do not prove or disprove the efficient market hypothesis. Think about what a bubble is. The bubble is an idea that prices will go up and then they'll eventually collapse. Is it smart to invest in a bubble? It can be really smart to invest in a bubble, right? If the price is going up, buying low and selling high means you ride the bubble and you make huge profits, okay? So a bubble does not mean the efficient market hypothesis is right or wrong. Secondly, ask yourself, right now, Bitcoin is way up. This is 2013 when he said this. Now Bitcoin's at like $60,000 a unit at the time that I'm saying this, right? Do you think Bitcoin's going to go up or down in the future? The bottom line is we don't know. What the price of Bitcoin is right now, $58,000 a coin, that's a balance of what investors expect. If people really thought it was going to go up, it'd go up even higher. If people thought it was going to go down, it would go down higher. So that $58,000 price balances all the buyers and sellers. We don't know what's going to happen to Bitcoin. And in fact, he said this 8 years ago, the bubble hasn't burst. And if you invested back in 2013, you'd be thrilled with your decision. Bubbles, big price increases, or big price collapses do not prove, nor do they disprove the efficient market hypothesis. Similar to this, I've seen people make the same argument for the 2008 financial crisis. People say that the housing market was a bubble. Well, people didn't know it was a bubble. That's why they were continuing to buy freaking houses in 2008. If people knew it was a bubble, they would have stopped buying houses. They would have shorted the housing market. A few people did that, but very, very, very few, right? Most were continuing to buy houses, thinking they would go up in value. If everyone thinks the price is going to go up, that shows how the efficient market hypothesis works. And the fact that the housing market did crash does not mean the efficient market hypothesis is wrong, okay? So when you have the financial crisis and the S&P 500 goes down 50%, I'm amazed by how many people think that that means the efficient market hypothesis is wrong. But the thing is, if the efficient market hypothesis was wrong, why didn't we predict this? If people knew the crash was coming, they should have been selling stock, short selling stock, which should have caused the price to go down before 2008. When the market suddenly has these big jumps up or big collapses, that's because people didn't know it was going to happen, right? So that doesn't prove the efficient market hypothesis is wrong, okay? And one more example, just to give us one that's incredibly relevant to us right now, let's think about GameStop. GameStop went up for, a few dollars a share up to, at one point, $500 a share over the course of just a couple of months. Does this mean the efficient market hypothesis is right or wrong? It doesn't mean either, right? When the price was $3 a share, there were people buying GameStop. When the price was $3 a share, there were people shorting GameStop, people making completely opposite bets because they didn't know, right? They didn't know what would happen to the price. The price went up to $500, and when it was at $500, I remember looking at it. I didn't know if it was going to continue to go up or down, right? No one knew. And that's what the efficient market hypothesis is at its core, is the realization that prices are based on something. Prices are based on information, but we cannot predict price changes in the future. So if we're going to try to figure out what happens in the stock market tomorrow, what's going to happen to it a year from now, it's so hard to figure out. And maybe it's just impossible, right? If it's impossible, the efficient market hypothesis is pretty much true, but we have no way to prove it, all right? If you want more information on this, if you'd like to study it more, shoot me an email and I can give you some more resources. There's so much content out here on the efficient market hypothesis. But I think in terms of passing knowledge, if you took in what this video is showing you, that's really all you need to know. Given that we can't prove or disprove it, there's not a real reason to jump in unless you're just interested.